Oh, and tell me a little bit about what surprised you in 2017, if anything.
I think the volatility was definitely a big surprise, but in addition to that, just the level of growth, when you look at globally, how much growth we did throw off, I think it was quite a bit above what people were looking for. When you look at earnings growth here in the US, I think that was a positive surprise to the upside. In addition to the lack of volatility, I think the fact that interest rates haven't moved up. We haven't seen inflation. So here we are with pretty decent growth in 2017, yet without any corresponding signs of inflation. So when you look at that tied into then on the currency side, the fact that we didn't see, I think a lot of people were predicting strength in the dollar associated with the fact that interest rates here were marching higher. When you look at the returns as a U.S. investor investing outside the U.S. with the weakness in the dollar, it's been a pretty surprising event. So I think that all combined together, lack of volatility, the overall strength of the global economy, the strength of the U.S. economy, and then the lack of inflation and tying that into kind of where interest rates are, pretty surprising year at many fronts.
If we had asked you this question, let's say in late 2016, what were some of the things you would have expected to see in 2017 that maybe you didn't?
I mean, when you look at the equity returns, right? Normally, when you get this late in a cycle, typically what you'll see, especially with interest rates starting to move higher, multiples start to compress. So here we are, looking at 20% plus type of returns, and a pretty decent year on the earnings front, but not 20%. So normally, you would start to see that multiple compress, but we've seen kind of an expansion in terms of what people are willing to pay. So it speaks volumes, I think, in terms of the fact that there's still so much money floating around when you look at the easing and the fact that we still have all that capital out there, and I think that may be a challenge going forward.
A lot of investors did come into 2017 pretty trepidatious when maybe throwing caution to the wind might have been a good strategy if you really wanted to capture all the upside in 2017. Are there any lessons you're going to pull from this past year forward into 2018?
Well, I think when you look at kind of what drives markets in general, it's one or two things. Typically, it's going to be monetary policy, which is still somewhat favorable, even though we're operating at pretty low levels. So not to get too caught up in the valuation aspect of it. And the second one really being growth. And when you look at what drives equities, a combination of the two is always great to have. And I still think we're kind of in that area where asset classes in general can continue to melt higher because of what we came out of. We came out of such a steep recession, and you can see it in relation to kind of the fact that we're all talking about the lack of inflation with pretty much full employment in the US. I think it speaks volumes in terms of kind of the slack that we probably still have in the economy and how we're measuring that going forward relative to how we have from a historical standpoint. So not to be afraid of the fact that even going forward, we're probably going to continue to see good growth, not to be afraid to really continue to invest in riskier asset classes, because I think that's going to be the name of the game for quite some time, given the point that we started from, which was so depressed.
Potential for more of the same.
Exactly.
And tell me a little bit about your outlook for 2018.
I think more of the same. I think we're going to be looking at a coordinated economic expansion globally. I think some of the changes that we'll see will be more central banks, in particular probably Europe, start to move towards a tightening cycle. One of the issues I think that we'll keep an eye on is what happens politically over in Europe. You're seeing kind of a shift in terms of the ability to actually even govern when you look at what's going on, for example, in Germany. You're seeing nationalism really grow over there. I think that trend will probably continue, so there'll be some question marks around that. That will probably add some volatility to the overall market. I think emerging markets are in very good shape. In addition to kind of, I think, the comment that Michael made about technology, I think you're also seeing a big trend in relation to a true emerging market becoming a developed market. So, I've been at it for 30 years, and we've yet to have a graduation ceremony where you went from the emerging markets to the actual developed markets. But when you look at what's going on in China, when you look at what's going on in India, in China in particular, right, just the emergence of a middle class and how that's driving so much demand globally in the certain segments of the market. So I think you couple those two big changes together, and it's probably once in a lifetime type of event in relation to that overall demand and how that's going to push certain categories. We've saw it initially with commodities and what the market in China did to the commodity space. We're now seeing it in other segments like autos, where they're now the second largest consumer of autos. So I think those trends speak volumes, but I think the areas of concern would be geopolitical. I don't think there's a lot really you can point to from a bubble perspective where there's too much capital going into a segment of the market like a few years ago in the energy segment. Mortgage and technology all went through kind of their bubble phases. I don't really see that currently. Asset classes are expensive, but they're not absurdly expensive. So I think the biggest risk out there in 2018 is really going to be geopolitical.
Well, going back to that question about expensive, I think in the beginning of 2017, we were already asking, is the U.S. market richly valued? And now at the end of 2017, people are still asking that question. Do you think there's going to be a definitive yes or no either way next year?
I don't. I think it's going to continue to trade at pretty lofty levels, and I think part of it is just, again, when you look at kind of what bull markets die of, they don't die of old age. They die for a reason, and it typically is either a bubble being popped, and we got very used to that over the past several cycles, or the old way that it used to happen, where they matured and the Fed started to raise interest rates and try to soften the economy, and you started to get inflation showing up. Here, I think because of the trends that we're seeing on the technology side, because of what's going on in terms of the global nature of the world economy, I don't think we'll see. Once again, I think we'll probably end up being a little bit surprised at the end of 2018 that we don't see a large amount of inflation. It's starting to creep in a little bit. There's definitely wage inflation occurring, but I think margins will hold up. I think equity markets will benefit from a year-over-year growth in earnings. You tap on, every company's being asked now about the impact that the tax cut will have in terms of their earnings. It's substantial. The fact that we'll probably get something in addition to that as we progress through 2018. So I think there's a lot of meat on the bone in relation to kind of building that base of stability around equities, especially from an earnings perspective.
Let's talk a little bit about the political calendar. And Owen, I'm going to kick off with you because you just referenced it. When you look ahead at the political changes that are on the horizon, and tax reform is perhaps forefront in all of our minds right now, what are you expecting in 2018? And is there anything that you're keeping an eye on that might throw a wrench into some of this continued optimism?
I don't think if we get past tax reform, I think it's probably an easier path, because then we have a major legislative victory on the part of the administration, and then you can see kind of what lines up behind that, right? We're talking about welfare reform, which isn't necessarily positive for the economy, but you're also looking at infrastructure at some point in time where there's probably an agreement across the aisle in relation to getting an infrastructure bill done. So I think politically, if we get through tax reform, I think it gets a little bit easier in 2018. And the magnitude of kind of what we're looking to do as an administration is probably a lot lighter than what they really tried to tackle here in 2017 between healthcare and tax reform. So I think it's a little easier.
And when we think about the different facets of tax reform, is it the lower corporate tax rate, the repatriated cash? What are you really keeping an eye on, or what are you excited about?
The lower corporate tax rate's a big one, but also I think the consumer and consumer spending will be a big one. When you look at kind of, that's an area that it's two-thirds of our economy, so you want the consumer to participate and be part of it. So I think getting more money in their pockets is pretty critical too. The repatriation, I think, at some point in time, do they tie that into an infrastructure type of bill and help pay for that? Hopefully that is the case, because I think we all know that we need it. So I think, it all tied together is a pretty good picture. Some of it's kind of more putting a level playing field together. When you look at the U.S. corporate tax rate relative to other developed markets, we're still way off the mark. So I think 20% is kind of in a more competitive environment, which will, I think, be helpful. There's going to be a lot of political pressure. We've seen it already in relation to bringing back jobs to the U.S., so there'll be a lot more rhetoric, I think, around that, which will, if it does happen, will be helpful. So I think there's a lot to be positive about, but there's still a lot of structural issues that we face as a country that we need to solve. I mean, nobody's talking about reforming any type of entitlements, and we know with $20 trillion in debt and with interest rates starting to move up, that interest expense becomes a larger portion of the federal budget on an annual basis will become a bit more challenging. So I think down the road, the canary in the coal mine really screaming out loudly is the fact that at some point in time we have to tackle that. Nobody wants to handle that, right? We had 18 Republicans run for president. Not a single one ran on, I'm going to raise your taxes and I'm going to cut your entitlement program, right? That's just not going to happen. But I think that would be positive from a structural standpoint if we ever got to the point and really tackled that. I think that would be a big positive, because if you look at globally, we went from, the big bubble out there is one that's very manageable, but we went from a tech bubble. We didn't really solve it. We created a mortgage housing bubble, and then we transferred that all to sovereign debt, and sovereign debt bubble. We just buried it under the rug and said, let's deal with it down the road. So I think you can get away with that. Can't get away with that if you have a brokerage account and your tech stock goes down. You can't get away with that if you own a house. But it seems like the federal government can just turn the printing press and continue to print more money and keep things going. So
yeah, paying the piper doesn't look
right?
so good on a bumper sticker for a campaign, I guess.
We all wish we had that level of debt and could continue to spend.
If only, and I know I could. Do you echo this general theme?
I do. I think, we've, as I mentioned earlier, just transferring that debt load to sovereigns, I think ends up capping growth to some extent, but also caps volatility. So until we get kind of off of, we talk about an opioid epidemic, when you look at kind of the debt addiction that the global developed economies have, it's kind of incredible when you think about it, right? And it started with Japan in the 1990s in terms of blowing out, from a ratio perspective, their debt to GDP, and now you're looking at the rest of the developed world kind of following suit. So until we get to the point where we address those issues, I think it's going to be a challenge from the standpoint of overall growth, really probably achieving the levels that we've seen historically, but it also is probably going to mean that we see a lot less volatility. I mean, look at credit spreads, where credit spreads stand today relative to historical standards. So we're not even seeing the normal type of functioning market where certain high yield instruments over in Europe are yielding less than treasuries here in the US. I mean, that's a bubble, but I don't think you're going to see a pop anytime soon. Credit here in the US is in pretty good shape when you look at delinquencies, other than maybe a couple small pockets like auto, where there's a little signs of weakness, and obviously student loans. But in general, there's really nothing out there when you look at all the different issues that we dealt with in the 1990s in terms of debt bubbles, whether it was Russia, the Thai baht, Mexico in 94, and then obviously the tech bubble and mortgage bubble. I don't think I think the answer at some point in time doesn't mean layer on more debt, right? And even as a society here in the US, you look at kind of the tax code that we have, and I think we're starting to address it a little bit, is let's not reward people for going out and borrowing money and deducting that from their income statement. Let's reward people for saving a little bit. You look at the savings rate here in the U.S. and it's been quite low, but I think been an issue for us. So I think we're talking probably 5, 6, 10, 20 years down the road, maybe where we get serious and say, you know what, maybe this isn't a good idea. But ever since we've had a central bank, Woodrow Wilson put it into place way back when. In the 1880s, we used to have a lot of volatility in markets. Markets would blow up and get recreated. But ever since central banks have been running, we seem to be enamored with kind of this concept towards funding as much money into the system and protecting us from the downside. The problem with that is, it creates an avalanche at some point in time, because the downside's a lot harder. Like I mentioned earlier, it's difficult to call someone up and say your tech stock's down, you need more collateral in your account. It's difficult to foreclose on a home. It's impossible to get Washington, D.C. to agree upon some type of plan to put in place to reduce the overall debt burden the U.S. has.
I think that's a really interesting point, and I wonder if you agree with the other point, is that I don't think, at least in my experience, certain developed markets have really been punished for having that high debt to GDP. Because if you think about, Japan's a good example, you mentioned it, Owen. I want to say most indebted nation probably on the planet, I believe.
But controlled, right? Because they own most of it. Right?
Yeah, exactly, controlled. And yet, the Japanese government can still borrow at extraordinarily low levels, has an excellent credit rating. So, it's almost as if the market doesn't seem to mind at the moment. And, I think that's been going on for a little while. Certainly post-crisis, we're living in a world now where it turns out, government balance sheets can handle much more debt than we probably originally thought. I can remember back in the day when you think about debt to GDP of being more like 40, 50% was kind of what was accepted. Now that's doubled, in some cases more than that. And yet I don't think there's been a commensurate punishment from the market. In fact, you could argue the opposite has happened. The more, some countries have borrowed, the more they're able to borrow cheaply. It's very hard, isn't it, when you're racking up debt and a market is still saying to you, take some more and take it at lower rates.
But I think the day of reckoning will come when interest rates start going up. Because if you look at discretionary budgets, whether it's a town in the U.S. or the federal government, the discretionary budget as a percentage of the pie just keeps shrinking, right? So we have mandatory payments in terms of defense, entitlement programs, and the discretionary portion of it keeps shrinking. And I think today interest expense is in the high single digits in terms of the overall budget. But could you imagine if we were sitting here today with a 10-year at 5%, what the interest expense would be in terms of our total spending? So that's when people will get serious and sit down and say, you know what, let's actually address the issue. We know the answer, right? The answer when Simpson Bowles were commissioned on the part of President Obama, they came up with the answer. He took a look at it and said, if I implement this, I'm a one-term president. And anyone would have reacted that way, right? It's just not something anyone really wants to address. So it will happen at some point in time. And that's why we're kind of lucky, right? We're sitting here at the end of 2017 with 3% growth and subpar inflation. So it's really been a great situation. I think a lot of that relates back to your comment you made earlier about technology and seeing kind of so many trends, so many secular trends in the market that are really truly preventing inflation from going higher. It's unusual to be in a period of economic growth to have private label growing as a percentage of consumer spending, but yet it's happening, right? We're all comfortable going out and today not buying a branded product. So it's not only technology, it's just kind of consumer spending habits.
Tell us about a theme that either worked well last year and you're continuing into next year, or anything that you think is really going to be standout.
I think risky assets still. I think when you look at the backdrop in terms of what should happen in 2018, even though you have certain central banks starting to tighten, it's still loose enough, I think, where we still see risky assets do well. Global growth will continue. And then when you look at the fact that you're looking at decent earnings growth, I think that will also help support equity markets in particular. And then within equity markets, I think you still have to favor secular growth over cyclical, because cyclical has been a very difficult game to play. There aren't too many end markets out there that are doing exceptionally well. We're still way under peak levels, for example, in housing in terms of how many housing units we're actually building per year. It's probably going to take a long time for that to ever really recover. And even from a generational standpoint, we're going to see millennials buying homes the way people did in the past. So I think end markets from a cyclical standpoint are very difficult to make, but when you look at the secular trends that are going on, they're probably some of the most powerful ones that we've seen in our career, especially within technology. I think you are seeing some good long-term opportunities. We're probably going to be seeing driverless cars in 5 to 10 years, and a concept that really changes things quite dramatically. When you look at artificial intelligence and the move up to the next level in terms of inference on the part of computers, it's a pretty substantial step, and I think that's a whole new landscape. We really haven't made, when you look at kind of technology in general, really haven't made any major advancement. We've improved upon things. We've improved upon the telephone, right? We don't have to have it corded to a wall anymore. We can actually walk around with it and use it for very different functions than we have in the past. The airplane's going about the same speed it did back in 1960s when the first 747 took off, and we still have 747s flying today. But I think with technology from a step function standpoint, especially with artificial intelligence, the scope of it's going to be, I think, pretty mind-blowing and pretty substantial in terms of the impact that it will have on the market. And displacement, you're talking about if we do go to driverless cars as an example, where do all the individuals that are making a living today off of that type of function, where do they go? So I think there's going to be a lot of displacement. So I think we're at the beginning stages of another kind of revolution in relation to technology, where we saw it probably in the late 1800s change lives dramatically from a healthcare standpoint. I think healthcare is also, I think the thing about technology this go around, it's going to have an impact on so many other markets that it hadn't had in the past. So when you look at what's going on today in relation to, we mapped out the human genome back in the 1990s, and today we're looking at the ability to probably get to the point where we really privatize and make specific drugs for the individual rather than for treating a whole population of people that have a certain disease. So I think there's a lot that we'll see in the future, frankly, that will speed things up because of what's going on in technology, because of artificial intelligence in particular.
And tell me a little bit about Aristotle and where you feel that your solutions fit into a broader portfolio.
Sure. So I think Aristotle is an equity shop. We run multiple equity strategies, large cap value. The two strategies that my team runs here in New York are large cap growth, large cap core. And then we have a group up in Boston running small cap core. And really the focus is really stock selection. I think when you look at kind of the strategies that we run, we have in-depth individuals doing the analytical work around them. And the large cap growth, large cap core strategies, what we're really targeting is selection being the driver of our performance. So we're very careful in terms of how we allocate our risk budget when you look at beta, when you look at currency, when you look at industry and various types of risks that you can take on in a large cap equity portfolio. We really want to emphasize selection risk as our number one risk. So we really want to pick the right companies. We want to get to know the management team, and we want that to drive performance. We think it's increasingly difficult, especially with the environment that we outlined earlier, to really make calls around more macro type of events, especially currencies, especially which direction the economy's headed, interest rates. And we've been talking about interest rates going higher ad nauseum for quite a few years now, and needless to say, we're still sitting here at pretty low levels. So I think those are the challenges in this environment, and the way to tackle it to a large extent is really concentrate on what you're good at, and that's really what we've specialized in terms of beating the indices that we've been up against for years by really focusing in on stock selection.
Just to briefly summarize, maybe one major theme or point that they should take away with them as they move into 2018.
Yeah, I would say stick with risky asset classes. I think it's setting up for a stage where you're going to continue to see good returns coming out of them. I don't think we really can afford to have a recession. There's too much debt on the part of sovereign entities to go through that. So I think it's going to be more of the same in 2018. And frankly, either from a governance perspective, but also from an operating standpoint, given the global economy, I think companies in general are that much more competitive. And there's a lot of, I think, underlying growth trends that are in the market, in the global economy today that are extremely attractive that I mentioned in relation to secular trends that are really going to result in, I think, really good returns in those risky asset classes. So even though interest rates are starting to march up, and there's a tendency maybe to start to rotate into fixed income, I think equity asset classes in general are probably going to be the better 2018 story.